In September 2008, Lehman Brothers collapsed, triggering the worst financial crisis since the Great Depression. The stock market lost 57% of its value over the next 18 months. Millions of people lost their homes, their jobs, their retirement savings. But here's what most people don't know. If you knew what to look for in the charts, you could have seen it coming months in advance. There was a specific pattern that appeared before the crash, a pattern that told you not just that a crash was coming, but exactly when it would hit. That same pattern is appearing right now in 2026. And in this video, I'm going to show you exactly what that pattern is and what it's pointing to for the next crash. If you're new here, welcome. I analyze economic patterns and market data to help you understand where the economy is really headed. And today, we're looking at one of the most accurate crash predictors in modern market history, the 2008 pre-crisis pattern. Now, before we dive in, let me be clear about something. I'm not saying the market will definitely crash. I'm not a fortune teller. But what I am saying is that there's a pattern that appeared in the months before the 2008 financial crisis, and that exact same pattern is playing out right now in early 2026. And if this pattern follows the same timeline as 2008, we can calculate almost to the week when things could start to fall apart. So let's look at the data. What happened in 2008? And let me take you back to 2008. Most people think the financial crisis started in September 2008 when Lehman Brothers collapsed. But the truth is, the warning signs appeared much earlier than that. The pattern actually started in December 2007, 9 months before Lehman collapsed. Here's what the timeline looked like. December 2007, February 2008. The setup. The market hit its all-time high in October 2007. But by December, we started seeing cracks. Bear Stearns had to bail out 2 of its hedge funds. Home prices were falling. Foreclosures were rising. But the media was still calling it a soft landing. Most people thought everything was fine. March 2008, May 2008. The warning phase. In March, Bear Stearns collapsed and had to be sold to JP Morgan for pennies on the dollar. This was a major warning sign, but the market rallied afterward. People thought the worst was over. This is the phase where smart money was quietly exiting. You could see it in the institutional fund flows. Large hedge funds and banks were reducing their exposure. June 2008, August 2008. The breakdown. The market started making lower highs. Each rally was weaker than the last. Volume increased on down days. Critical support levels broke. And most importantly, a specific technical pattern formed that appears before every major crash. September 2008. The collapse. Lehman Brothers filed for bankruptcy on September 15, 2008. The market went into free fall. The rest is history. But here's the key. If you were watching the pattern, you knew it was coming. The timeline from the first warning signs to the collapse was almost exactly 9 months. The pattern explained. So what is this pattern? What was everyone missing? It's a combination of 3 things. First, the distribution phase. This is when institutions, the big banks, hedge funds, pension funds, start selling their positions. But they don't do it all at once because that would crash the market immediately. Instead, they sell slowly over months into any rallies. You can see this in the volume data. In 2008, you saw heavy volume on down days and light volume on up days. That's distribution. Second, the lower highs pattern. Each time the market rallied, it couldn't quite reach the previous peak. It would rally to, say, 1400, then fall. Rally to 1350, then fall. Rally to 1300, then fall. This is called making lower highs, and it's a clear sign that buying pressure is exhausted. Third, the support break. There are key price levels that the market has historically bounced off of. In 2008, the market broke below critical support levels in June and July. Each break was a warning sign. When all 3 of these things happen together, distribution, lower highs, and support breaks, it creates a pattern that has preceded every major crash in modern history. And the timeline is remarkably consistent. From the first signs of distribution to the crash is usually 8 to 10 months, where we are now in 2026. Now, let me show you why this matters for 2026. This is the market right now, and this is the 2008 pattern overlaid on top of it. Look at the similarity. May 2025, July 2025, the setup. The market hit all-time highs in April 2025. By May and June, we started seeing warning signs. Commercial real estate problems, regional bank stress, rising credit card defaults. But just like 2008, the media was saying everything was fine. Soft landing, no recession. Sound familiar? August 2020 to October 2025, the warning phase. In August and September, we saw our Bear Stearns moment. Several regional banks needed emergency support. There were liquidity issues, but the market rallied afterward, just like 2008. And just like 2008, institutional investors started reducing exposure. You can see it in the fund flow data. November 2025, January 2026, the breakdown. This is where we are right now. The market is making lower highs. Volume is increasing on down days. Critical support levels are breaking, with the exact same pattern as June, August 2008. If this pattern continues on the same timeline as 2008, that puts the Lehman moment, the point where something breaks and triggers the collapse, sometime in Q1 2026. Based on the 9-month timeline from first warning signs to collapse, we're looking at late February to early March 2026. Now, I'm not saying something will definitely happen on a specific date. Markets are complex. But what I am saying is that if this pattern follows the 2008 timeline, we're in the danger zone right now. Why this pattern works? You might be wondering, why does this pattern keep repeating? Why does it take 9 months? The answer is market structure and leverage. In 2008, the problem was subprime mortgages and derivatives. Banks were leveraged 30 to 1 or more. When the housing market turned, it took months for the losses to cascade through the system. In 2226, the problems are different. Commercial real estate, corporate debt, regional banks, but the structure is the same. High leverage, interconnected financial institutions, complex derivatives. When the cracks first appear, institutions have time to try to manage their way out of it. They sell slowly, they raise capital, they try to avoid panic. That's the distribution phase. It takes months. But eventually, someone runs out of liquidity. Something breaks, and that's when the cascade begins. That's what Lehman was in 2008. Not the cause of the crisis, but the trigger that started the cascade. The pattern works because it reflects the structure of how leveraged financial systems unwind, and that process takes about 9 months from first warning to final collapse. Call to action. So what should you do with this information? Again, I'm not a financial advisor. This isn't financial advice. But if I were looking at my own portfolio right now, knowing what I know about this pattern, I'd be asking some hard questions. What's my exposure to stocks right now? Do I have enough cash on the sidelines? Are my stop losses in place? Have I thought through what I'll do if we get a 2008-style crash? This pattern doesn't guarantee a crash, but it does suggest we're in a high-risk environment similar to mid-2008. If you want to follow along as this pattern develops, hit subscribe and turn on notifications. I'll be tracking this weekly and updating you if anything changes. Also, drop a comment. Do you see the similarities to 2008, or do you think this time is different? Let's discuss. Thanks for watching. If this was valuable, hit the like button. It helps more people see this analysis. I'll see you in the next one.